Here are 5 pension payment versus lump sum factors you are likely not considering. Welcome, my name is Daniel, founder of McCluskey Financial, and the first is behavioral risk. You have to understand that if you are taking the lump sum, whether you're rolling it into an IRA, a brokerage account, doesn't matter, you have the ability to take as much of or as little money as you would like from that account. If you overdo this, you could very easily run out of money. If you are taking the lifetime payments, whether you like it or not, you are receiving that money every single month. If you need more money for whatever reason, you are going to have to figure out another solution. If you don't need all of the money, you are getting it anyway. So even if you do end up struggling later on, you will always have that baseline there. So if overspending is potentially a problem for you, giving yourself literally no option but to have that money paid to you every single month can be a great hedge against that. Think of it like if you are trying to diet and stop eating junk food. You could develop the habit to just stop eating it even though it's still in your house, and you can allow other people to just have it instead. You could develop that strength. Or you could still try to develop that same restraint but remove the food from your house so it's much more difficult or next to impossible to have that food throughout the day. A little bit different, but in this case, you cannot take out extra money even if you wanted to. That temptation is removed. Second is protecting that money from a potential lawsuit. If you take the lump sum and you roll it into some sort of brokerage account, for example, the funds may be able to be taken if you are sued because it's an asset that you have. If you take that money as premium payments in the form of money that's coming into your account every month from the pension company, it's going to be much more difficult to declare that as an asset because you don't even have the option to pull that money out, so it's going to be much more difficult to get to. Of course, this can vary by pension company and state, but worth considering. Third is that even if your pension company does have a cost of living adjustment for inflation, which most of them do not, still, this may not keep up with actual inflation. For example, Social Security has a cost of living adjustment. If you see, I put this simulation in today's dollars. At age 63, they are receiving $27.1 thousand. At age 90, again, this is just in today's dollars after you account for inflation, they're receiving $25.7 thousand. That means over that time, the amount they were receiving relative to inflation has depreciated by about 5.2%. And that's just with where it's at currently. Now, this may not seem like very much, but it does illustrate the point that this is a consideration and it could be much worse for a private insurance company. Now, also, Social Security is currently running into some solvency issues at the time this is being filmed, and one of these suggestions is reducing the cost of living adjustment by 0.3%, which would be around a 25% fix to the current funding problem. This is real, it's worth considering, and you've got to realize if these companies are going to go belly up, they're going to do everything they can to save themselves. They're not going to at least try something before they go bankrupt and hopefully let the government pick you up. Which leads us right in to our next point, which is number 4. You need to look at your pension provider's stability. So not only their financial ratings, but also their history. So whether that's state pensions or corporate pensions, for example, Rhode Island in 2011 raised their retirement age and reduced the cost of living adjustment. The Detroit Municipal Pension in 2013 also saw cuts around 4.5% and reduced their cost of living adjustment as well, just like we alluded to in the last point. For corporate pensions, this has happened a number of times. Now there is, depending on the company, PBGC, which is basically the government program that is willing to some extent be kind of the backstop if the pension companies do go under, kind of like FDIC with banks, anything under $250,000. If a bank goes under, the government is going to pay that money out. Of course, that comes from our tax dollars, but same thing is happening with the pension companies in PBGC, like with United Airlines in 2005, like with Sears in 2018, and more. So do a little bit of research into your company's history, into their ratings. If you can, feel free to ask questions. Important to note this down. Hey, real quick, if you're finding this video helpful, leave a like and let me know. Finally, number 5, if you are set on taking the premium payments as opposed to the lump sum because you want that money there for the rest of your life no matter what, because of the behavioral risks, whatever that is, you may want to consider taking the lump sum and using that lump sum to buy your own private pension through a different organization, most of the time a private insurance company. You should at least check, even if this isn't very common, to see if you can get a higher payout simply by taking the lump sum, rolling it into a different company, and turning on the income the same way that you would have done if you just took the premium payments. This time, it's just with a different company. So the first reason, of course, is because of higher payouts for you. Also, could be better cost of living adjustments, and keep in mind both of those could change based on taking it single or taking it joint. Second, of course, is there may be better options for if you pass away early, 10 years in, even 20 years in, for leaving a possible death benefit to heirs when you go. Third, of course, this ties into our last point. Companies may be much healthier financially, of course, since you are the one who gets to pick which company you would be rolling that lump sum into to create your own pension. You could go with one that has a good history and is financially stable. And finally, if you are concerned about that behavioral risk of making sure that you have that money for the rest of time, but you also have a little bit of concern that there may actually be some real times where you do need to go a little bit above what the pension company is paying you. You do generally have, not with all private insurance companies, but with most products, they will offer flexibility in terms of free withdrawals that you could take above the amount that you're actually receiving if you needed it for some sort of emergency. Now, of course, because you take money out from that account value, you would start receiving less income after that, but it's there as a safety net. If you're within 10 years of retirement in the US, there's so many different things you can do. You just don't know what specifically to focus on. Subscribe. I release videos for you twice a week on how to do that peacefully.